Welcome. If you're new to investing, you might feel overwhelmed by all the choices and risks. But don't worry, safe investing is possible, even for beginners. In this video, we'll walk you through the basics of investing safely, step by step. You'll learn how to set your goals, understand your risk tolerance, and choose the right investment options. By the end, you'll feel more confident about making your money work for you without taking unnecessary risks. Let's get started on your journey to secure financial growth. You might wonder, why should you invest at all? Simply put, investing helps your money grow over time, outpacing inflation and building wealth for your future. While saving money in a bank account is safe, it often doesn't keep up with rising prices. Investing, on the other hand, gives your money the chance to earn more through interest, dividends, or capital gains. Even small amounts can add up over the years. So, investing is a key step toward achieving your financial goals, whether that's buying a home, funding education, or retiring comfortably. Before you start investing, it's important to understand risk. All investments carry some level of risk, which means you could lose money. However, not all risks are the same. Some investments are riskier than others, while some are considered safer. Knowing your own comfort level with risk, called risk tolerance, will help you choose investments that fit your needs. Remember, higher returns usually come with higher risks, so it's about finding the right balance for you. Setting clear investment goals is the first step to investing safely. Ask yourself, what are you investing for? Is it a short-term goal like a vacation? Or a long-term goal like retirement? Your goals will determine how much risk you can take and what types of investments are suitable. Write down your goals and the time frame for each. This will help you stay focused and avoid making impulsive decisions when the market changes. Before you invest, make sure you have an emergency fund. This is money set aside for unexpected expenses, like medical bills or car repairs. Experts recommend saving 3 to 6 months worth of living expenses in a safe, easily accessible account. Having an emergency fund means you won't have to sell your investments in a hurry if something goes wrong. It's your financial safety net. You don't need a lot of money to start investing. Many platforms allow you to begin with just a small amount. Starting small helps you learn the ropes without risking too much. As you gain experience and confidence, you can gradually increase your investments. Remember, consistency is more important than the amount you start with. Regular contributions, even if small, can lead to significant growth over time. One of the safest ways to invest is through diversification. This means spreading your money across different types of investments, like stocks, bonds, and real estate. Diversification reduces the risk of losing everything if one investment performs poorly. Think of it as not putting all your eggs in one basket. By owning a mix of assets, you can smooth out the ups and downs of the market. Stocks represent ownership in a company. When you buy a stock, you become a partial owner and can benefit from the company's growth. Stocks can offer high returns, but they also come with higher risks, especially in the short term. For beginners, it's wise to start with well-known, stable companies or consider stock index funds, which spread your investment across many companies. Bonds are loans you give to companies or governments. In return, they pay you interest over time and return your money at the end of the term. Bonds are generally less risky than stocks, making them a good choice for conservative investors. However, their returns are usually lower. Including bonds in your portfolio can help balance out the risks of stocks. Mutual funds and ETFs, exchange-traded funds, let you invest in a collection of stocks, bonds, or other assets. They're managed by professionals and offer instant diversification, which helps reduce risk. For beginners, these funds are a simple way to start investing without having to pick individual stocks or bonds. Look for funds with low fees and a solid track record. Index funds are a type of mutual fund or ETF that tracks a market index, like the S&P 500. They offer broad diversification and typically have lower fees than actively managed funds. Because they simply follow the market, they tend to perform well over the long term. For beginners, index funds are often recommended as a safe, low-cost way to invest. Robo-advisors are online platforms that use algorithms to manage your investments. They ask about your goals and risk tolerance, then build and manage a diversified portfolio for you. Robo-advisors are a great option for beginners who want a hands-off approach. Fees are usually lower than traditional advisors, and you can start with a small amount of money. Unfortunately, the world of investing has its share of scams. Be wary of promises of guaranteed high returns or pressure to act quickly. Always research any investment opportunity and stick to reputable platforms. If something sounds too good to be true, it probably is. Protect your money by staying informed and cautious. Investment fees can eat into your returns over time. Always check what fees you'll pay, whether it's for buying or selling investments, or ongoing management fees. Lower fees mean more of your money stays invested and grows. Compare different platforms and funds to find the best value for your needs. Compound interest is one of the most powerful tools in investing. It means you earn interest not just on your original investment, but also on the interest that money earns over time. The longer you invest, the more your money can grow. Starting early gives you the biggest advantage, even if you start with small amounts. Dollar cost averaging means investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps reduce the impact of market volatility and takes the emotion out of investing. Over time, you buy more shares when prices are low and fewer when prices are high, which can lower your average cost per share. Over time, some investments in your portfolio may grow faster than others, changing your original mix. Rebalancing means adjusting your investments back to your target allocation. This keeps your risk level in check and ensures your portfolio stays aligned with your goals. Review your portfolio at least once a year and make changes as needed. Safe investing is all about the long term. Markets will go up and down, but staying invested and sticking to your plan is key. Trying to time the market or react to every headline can lead to costly mistakes. Focus on your goals and give your investments time to grow. Patience is your best friend in investing. Using tax-advantaged accounts, like IRAs or 401ks, can help your investments grow faster by reducing the taxes you pay. These accounts offer tax benefits for retirement savings, so take advantage of them if you can. Each country has different options, so check what's available to you and consider using them as part of your investment strategy. Automating your investments makes it easier to stay consistent. Set up automatic transfers from your bank account to your investment account each month. This way, you invest regularly without having to think about it. Automation helps you stick to your plan and avoid the temptation to spend instead of invest. It's important to review your investments regularly, check your progress toward your goals, and make sure your portfolio still matches your risk tolerance and time frame. If your situation changes, adjust your investments as needed. Regular reviews help you stay on track and make informed decisions. Investing can be emotional, especially when markets are volatile. It's natural to feel anxious when prices drop, but making decisions based on fear or excitement can hurt your returns. Stick to your plan and avoid reacting to short-term market movements. Remember, investing is a marathon, not a sprint. Everyone makes mistakes when investing, especially in the beginning. The key is to learn from them and not repeat them. Keep track of your decisions and outcomes and use them to improve your strategy. Remember, even the best investors make mistakes. It's part of the learning process. If you're unsure about where to start or how to build your portfolio, consider seeking advice from a financial professional. A good advisor can help you clarify your goals, assess your risk tolerance, and create a plan that fits your needs. Just make sure to choose someone reputable and understand how they're compensated. The investment world is always changing. Stay informed by reading reputable financial news, books, or taking courses. The more you learn, the better decisions you'll make. But remember, don't let information overload paralyze you. Focus on the basics and keep learning over time. As a beginner, it's wise to avoid high-risk investments like penny stocks, cryptocurrencies, or speculative ventures. These can be tempting, but they often come with a high chance of losing money. Stick to proven, stable investments until you have more experience and understand the risks involved. Inflation means that the value of money decreases over time as prices rise. If your savings don't grow faster than inflation, you're actually losing purchasing power. That's why investing is important. It helps your money keep up with or beat inflation, protecting your future spending power. Patience is a key ingredient in safe investing. Markets can be unpredictable in the short term, but over the long run, they tend to grow. Resist the urge to check your investments every day or make frequent changes. Give your money time to work and trust the process. It's important to have realistic expectations about investing. Safe investments usually offer moderate returns, not overnight riches. Understand that there will be ups and downs, and focus on steady growth over time. Setting realistic goals helps you stay motivated and avoid disappointment. High costs can eat into your investment returns. Choose low-cost funds and platforms whenever possible. Even small differences in fees can add up over time. By keeping your costs low, you keep more of your money working for you. Insurance can play a role in your overall financial safety. Make sure you have adequate health, life, and property insurance to protect yourself and your family. This way, you won't have to dip into your investments if something unexpected happens. Asset allocation is the process of dividing your investments among different asset classes, like stocks, bonds, and cash. The right mix depends on your goals, risk tolerance, and time frame. A well-balanced allocation helps you manage risk and achieve your objectives. Cash is the safest asset, but it offers the lowest returns. It's important to keep some cash for emergencies and short-term needs, but too much cash can mean missing out on growth. Find the right balance between cash and other investments for your situation. Choosing the right investment platform is important for safety and convenience. Look for platforms with strong security, low fees, and good customer support. Read reviews and check for regulatory approval before opening an account. A reliable platform gives you peace of mind. Markets naturally go up and down, sometimes sharply. This is called volatility. It can be unsettling, but it's a normal part of investing. By staying diversified and focusing on the long term, you can ride out the ups and downs without panic. Automatic contributions help you invest consistently, no matter what's happening in the market. Set up a recurring transfer from your bank to your investment account. This removes the guesswork and helps you build wealth over time. Good record keeping is essential for safe investing. Track your investments, contributions, and any changes you make. This helps you monitor your progress, prepare for taxes, and make better decisions in the future. Your investment timeframe is how long you plan to keep your money invested before you need it. Longer timeframes allow you to take more risk and ride out market ups and downs. For short-term goals, stick to safer investments. Match your investments to your timeframe for the best results. Before investing in anything, do your research. Learn about the company, fund, or asset you're considering. Understand how it works, what risks are involved, and how it fits into your overall plan. Informed decisions are safer decisions. FOMO, or fear of missing out, can lead to poor investment decisions. Just because everyone else is investing in something doesn't mean it's right for you. Stick to your plan and avoid chasing trends. Safe investing is about discipline, not following the crowd. Dividends are payments some companies make to shareholders from their profits. Investing in dividend-paying stocks or funds can provide a steady stream of income, which can be reinvested for even more growth. For beginners, dividends can be a safe way to earn while you invest. Organization is key to safe investing. Keep your financial documents, account information, and investment records in order. Use digital tools or spreadsheets to track everything. Being organized helps you stay on top of your finances and make better decisions. Your risk tolerance can change over time as your life circumstances change. Review it regularly, especially after major life events like marriage, having children, or changing jobs. Adjust your investments as needed to match your current comfort level. As you reach your investment goals, take time to celebrate your progress. Whether it's hitting a savings target or seeing your portfolio grow, acknowledging your achievements keeps you motivated. Remember, safe investing is a journey, and every milestone counts. You've learned the basics of safe investing for beginners: setting goals, understanding risk, diversifying, and staying patient. Remember to start small, keep learning, and review your plan regularly. Investing is a powerful tool for building wealth, and with these safe strategies, you're well on your way to financial security. Take your first step today and watch your future grow.